Since the start of the pandemic, physical retailers have gotten crushed. Given the fear of mingling with the public, the appeal of physical locations has dwindled over the past year, causing dozens of legacy players to file for bankruptcy, including JCPenney, J.Crew, Century 21, Guitar Center, Pier 1, and many more. But one retailer who has not only survived the pandemic but has gone parabolic is Dillard's. Since the pandemic lows, Dillard's was up a maximum of 1,409%. That's nearly 3 times their previous peak and nearly 100% more than Tesla's parabolic run. Not only has their stock gone to the moon, but Dillard's also has the fundamentals to back up this run. Dillard's has been posting record profits and their PE ratio is still under 10. So here's how one of the oldest and slowest moving companies was able to outperform even the most innovative companies in the world since the pandemic started. If you're not familiar with Dillard's, they're a very popular department store in the US who specializes in clothing and fashion. While I'm sure they have their own fan base that won't shop anywhere else, as far as the general public is concerned, Dillard's is just another department store like Macy's or Nordstrom. This isn't necessarily a bad thing though, as most of the competition doesn't have anything special going for them on the consumer side either. But unlike much of the competition, Dillard's has figured out a way to address this issue from the business side. You see, one of the biggest shortfalls of running a retail store is the massive overhead that comes along with each store. You have to pay for leases, maintenance, and dozens of employees regardless of whether you make sales or not. And given that retail stores don't have the highest net margins, even the smallest downturn in demand can leave you unprofitable. This isn't anything new though, and Dillard's has been strategically combating the shortfall by owning their stores. As of 2011, Dillard's owned 241 out of their 309 stores, many of which they transferred into a real estate investment trust or REIT. And today, this number is simply even higher with Dillard's owning 90% of their retail space. Just like us mortals, owning large amounts of real estate as a retailer is a massive advantage. Your monthly payments are building equity, your real estate is appreciating, you get tax write-offs for interest and depreciation, and most importantly, you have full control over your property. If a downturn like the pandemic does hit and you need to close some stores, you can cash in on your equity or you can become a landlord yourself. On the other hand, if you are leasing, you're gonna have to negotiate to end your lease early and probably pay hefty fines. All of the most successful retailers today, including Walmart and the Home Depot, own most of their stores. And they've all been taking the real estate side of the business extremely seriously for quite some time now. On the flip side, most of the dying retailers don't own their real estate or they were late to the game. JCPenney, for example, didn't form a REIT until they filed for bankruptcy last year. Clearly, owning their stores has been a great advantage for Dillard's, but this isn't their only cost-saving measure either. Another way Dillard's has been able to establish some stability in the cutthroat retail industry is leaning up the business. Historically, Dillard's has been known for being a higher-end retailer carrying brands like Calvin Klein, Coach, Ralph Lauren, and Michael Kors. But over the past few years, Dillard's has focused on appealing to the middle class and lower-income families as well through their clearance stores. As the name suggests, these clearance stores specialize in selling items that weren't able to be sold in regular Dillard's, and these stores have some of the best deals out there. Before sending merchandise to these clearance stores, Dillard's tries to price these items 60% off at their regular stores. And these items only make their way to clearance stores if they still don't sell. This means that only the most undesirable stuff make their way to clearance centers. But on the bright side, these items are often 70 to 80% cheaper by the time they make it there. Dillard's currently operates 30 clearance centers across the US, which has really expanded Dillard's target audience and helped them survive a time period in which many consumers were more frugal than ever before. Aside from appealing to lean customers, Dillard's has become much leaner themselves. Dillard's owns 100% of their corporate headquarters, distribution centers, and fulfillment facilities, which has minimized overhead. Dillard's has also been strategically closing a handful of stores that weren't performing as well. Thanks to these cost-cutting measures, Dillard's didn't have to furlough or lay off any employees during the pandemic, and their balance sheet has been remarkably healthy. Their debt-to-equity ratio currently stands at 0.4, meaning that they have more equity than debt overall. Also, their long-term debt is only $599 million, and their next payment isn't due till January of 2023. Considering that their net income over the past 12 months itself is $608 million, Dillard should not have any trouble handling this debt. As you can see, Dillard's has really strong fundamentals, but fundamentals alone aren't responsible for Dillard's exponential rise. Some of the most explosive runs originate from heavily shorted stocks as shorts exit their positions, and it's no different with Dillard's. Once the pandemic rolled around, countless hedge funds went all in on shorting recovery stocks. You know, the restaurants, the cruise lines, the airlines, the hotels, and of course, the retailers. Most of these bets played out very well as many of these businesses straight up filed for bankruptcy. But among these short-sighted plays, the hedge funds overlooked some gems like Dillard's, and this would come back to haunt them. As you all probably already know, we saw a massive rise in heavily shorted stocks near the beginning of 2021. Most of the momentum and hype went into GameStop and AMC, but naturally, many investors who had missed out on these plays flocked to other heavily shorted stocks. We saw dozens of posts about Dillard stock or DDS pop up on Wall Street Bets, and the DDS was able to recover to pre-pandemic levels through the GameStop rise. But it wasn't until the second round of short squeezes led by AMC that Dillard's truly went parabolic. Now, the SEC claims that the rise in AMC and GameStop was mostly fueled by momentum as opposed to an actual short squeeze. But regardless of the specific reason, the AMC and the GameStop runs were extremely beneficial to Dillard's. Unlike most meme stocks that stalled out after the momentum died though, Dillard's has continued their exponential rise thanks to the supply shortage. Most of us associate the supply shortage with the technology and lumber, but the supply shortage has also carried into the fashion industry as well. Now, Dillard's hasn't exactly pumped up prices to the moon like Nvidia, but they have been able to heavily cut back on discounts, which carries directly into their bottom line. For most of the 2010s, Dillard's net margins hovered at just under 5%. Right before the pandemic, Dillard's net margins were actually declining towards 2%, and it of course went negative during the pandemic. But since the start of 2021, Dillard's margins have sharply recovered and reached record levels of 10%. Most analysts didn't expect such numbers whatsoever. The analyst consensus for third quarter earnings was $1.93 per share, but Dillard's came in with an astounding $9.81, or 5 times the expected amount. As you would guess, this is the primary factor behind Dillard's recent 100% run in November. Dillard's has given back most of these gains over the past few weeks, but many argue that this is simply a great buying opportunity. Dillard's has proven strong resilience from the pandemic. They control a lot of real estate, and they have pretty strong financials. Also, even though their revenue has recovered significantly, it's not even back to pre-pandemic levels yet. Currently, they're about 5 to 10% away from pre-pandemic levels, and given that a lot of the competition has dropped out since the pandemic, it's very possible that Dillard's is able to outgrow their former self. It should also be noted that even after a 14x run, Dillard's is only worth $5.5 billion. Meanwhile, Lululemon pulls in roughly the same profit, but they're worth 10 times more, coming in at $53 billion. Dillard's doesn't have nearly as much hype as Lululemon, but considering Lululemon's valuation, it's not crazy to think that Dillard's could grow to a $15 to $20 billion valuation. At the same time though, many aren't nearly as convinced by Dillard's. Here's the thing, Dillard's may have strong fundamentals, but at the end of the day, they're still just a strong company in a dying industry. Year after year, malls are seeing less and less foot traffic, and people are becoming more and more willing to buy everything online. Dillard's is also decently competitive on the online side of things, but if e-commerce is the future, it makes little sense to operate such massive stores when most customers are just coming in to pick up an order or return an item. Something else to consider is that even though Dillard's will face less competition as competitors drop out, their real estate may also drop in real value. Virtually all of Dillard's stores are located in malls, which garner their appeal from offering customers a wide range of shopping options. But as competitors go out of business, there will be less tenants looking to lease or buy property in these malls. The properties will continue to go up in nominal value due to inflation, but it's very possible that they start to lose real value in the upcoming years. Also, real estate itself has gone parabolic over the past 2 years, so as real estate cools down, Dillard's balance sheet may start to look less bulletproof. But by far the biggest concern is the supply shortage resolving. Right now, the markets are extremely inefficient, but this should just be temporary. Many analysts argue that it's just a matter of time until Dillard's is forced to be more lenient with their discounts and their profits start to fall again to pre-pandemic levels. But anyway, at the end of the day, Dillard's was in a relatively strong position when the pandemic hit. They owned their stores and they were leaning up their business. Combine this with the meme stock craze and the supply shortage, and Dillard's was able to skyrocket 14x. But though Dillard's has strong financials right now, it's still heavily debated if Dillard's will be able to carry on this positive momentum, or if this is simply their last hurrah before their eventual demise. Which camp are you in? Comment that down below. Also, drop a like if you think that shopping for clothes in person is way better. And of course, consider joining our Discord community to suggest future video ideas, and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.